Today's webinar is about deal-based price management. My name is Finn Hansen. I'm the CEO of Stratinis. At Stratinis, we work with various international companies in optimizing pricing, analyzing pricing, executing pricing. One of the challenges we often see is the company's ability to find the right price when they do deals. A couple of practical things. If you have any questions during the webinar, please write them in the chat panel in GoToMeeting, and then at the end of the webinar we will take time to answer as many questions as we can. But otherwise, to limit background noise, the microphones will be muted during the main webinar. Also, practically, we will at the end of the webinar email you the presentation as a PDF file, so you will have it for later use. So, well, why deal management and why deal-based pricing? Well, this is a good example of one of the challenges that we often see companies facing. It's a quote from an 8 billion euro company, one of Stratinis' customers. And the commercial director, the global commercial director, is basically saying, well, it takes us 3 weeks to put an initial quote together if you want to get it right. But one of our competitors can do it in 3 days. So very often the key account managers tend to cut corners, drop prices, or otherwise not do as good job as they should when they price the deals, basically because otherwise they risk of not being considered by the customers who don't want to wait 3 weeks but expect a deal offer in 3 days as well. When the competitors can, why can't you? And it's quite typical of one of the challenges. There are many other challenges when it comes to deal-based pricing, but speed and accuracy are often characteristics of deals, or lack thereof are one of the challenges that many companies face. So what is deal-based pricing? Well, there's no textbook definition of it as such, but very often deal-based pricing focuses around there's a yes or no decision from the customer. Either we get the deal or we don't. Of course, sometimes it can be a continuation of a previous deal, or it can be something that maybe there's a framework, but we just adjust some minor adjustments in the deal. But very often there's a yes or no decision. Similarly, there can be quite a lot of money riding on the agreement. Again, traditionally, deal-based pricing focuses on, well, if we win the bid or the deal, then we make a lot of money, and we don't, we actually miss a huge opportunity. And when you combine that with the often deal long-term validity as well, so it can be difficult to change pricing once you have agreed with the customer. And that also makes it more important to get it right, but also sometimes encourages, especially salespeople, to cut some corners because, well, I really need this deal, otherwise I won't have a chance to do it again for another 2 years before the customer will be looking into the marketplace again. Sometimes there's a very formal quoting or tender process where companies need to offer a specific quote. And quite often, deals are also based or characterized by that they are complex in nature. There can be many products. There can be products and services bundled together, and you only get this price for this product if you also take 3 other services. And we can give you this discount, but only if you pay a certain amount of money for specific services, or we need to have certain order patterns or supply chain setups, etc., etc. And depending on the industry, deals can be extremely complex. It can be covering multiple countries, and they can even be involving quite a few people across the organization, both on the seller side and on the buyer side. And deals are often more complex than, let's say, traditional, classical transactional pricing, where you basically have a price and you sell the product, and that's about it. So what kind of types of deals could we see, and what kind of characteristics and challenges would we face depending on the type of deal? Well, one of the key questions is if you are in a market where there's a high frequency or low frequency for the individual salespeople. So do you have just 1 deal per year, or in theory you'd have millions of deals per year? If you're selling aircrafts to airlines, it's probably relatively few deals per year. If you're selling commodity industrial components, chemical compounds, or various other products, consumer goods, electronics, very often across the organization you actually have millions of deals per year to conclude. And especially when you have a lot of them, it's sometimes difficult to really have the right focus in the organization. It's sometimes difficult to have the right level of quality in an analysis, a level of quality in decision making. That means that especially in high transaction or high frequency industries, the deal quality goes down, usually to the benefit of the buyer. Another real challenge for many companies, and it's really increasing in across various industries, is whether you do deals at the local level or international level. And typically, in the old days, 20 years ago, you did a deal in Germany, you did a deal in Japan, you did a deal in Brazil, and that was it. Yes, you may have looked at what are we selling in one country and what are we pricing in one country, but at the end of the day, you could do whatever you wanted locally because no one was watching. These days, especially on the buying side, procurement has become much more professional, much more global, and many buying organizations can today compare the deals that they are getting around the world, and actually to a much larger extent than that the selling organizations can compare the deals they're offering around the world. It still doesn't mean that everybody is buying completely globally. You can mention examples from chemicals, electronics, consumer goods, where it's still the responsibility of the local sales organization and the local buying organization to find a local deal, a local demand, a local supply with a semi-local price. But on the buying side, then there's an international buying team who then compares the deals that they're getting, and if the deal is much better in Poland than it is in Germany or in the US or in China, then they will compare the prices, they'll compare the terms, and they will exploit those differences. We see a lot of challenges in industries where suddenly these price differences were not known in the selling organization, and the global procurement people will then use that to get additional discounts or even just harmonize to the lowest common denominator. Another challenge of different types of deals is that deals can be long-term or short-term. As I mentioned before, very often deals are long-term, or at least longer-term, but there can also be that deals can have a short-term aspect of them. So things like, well, prices can be changed, but only within certain parameters, or in a long-term deal where it's been very firm, it may not be possible to change the deal at all, or to change the prices at all. Quite common, especially in industries where there's a lot of raw materials with variations in spot in raw material prices. There would typically be some sort of framework agreement that says, well, this is the overall agreement and this is the price, but if the raw material markets vary by more than X%, then we still maintain the right to adjust our prices. But very often deals are locked, and that means that you need some sort of capability of looking into the future, some sort of capability of forecasting both your cost base, but also what's the willingness of the market to pay for these services, and for that matter, to some extent, what's the anticipated reaction of competitors. Not always easy stuff, obviously. Now, when it comes to the frequent deals and doing deals on a very regular basis, even if it's with different customers all the time, if I only have very little time to prepare as a salesperson, very often I get issues of quality of information. So what is my profitability of my deal? Am I actually making money on this deal or not? We recently worked with an industrial components manufacturer where basically they did not know whether they were making money or losing money, even at the gross margin level, not even to mention it after the fixed cost that they had to allocate to the customer as well. And the lack of information, or the lack of accurate information, is very often an issue in organizations where salespeople need to do many deals every weekday, month, rather than just working on one single deal per year. The other issues there, of course, is then the decision quality. So can I make the right decision? Also, if I'm pushed to make fast deals, if I have a need to close my deals very fast, can I make the proper decisions? Not only based on quality of information, but also simply is there time enough for myself, but also for maybe my management or for my colleagues to discuss what are the repercussions if we're changing prices. Repercussions maybe for neighboring countries where buyers are looking at the prices across borders, or simply just repercussions for next time we deal with the customer. He may have been, if he got a special discount or rebate, he's created an expectation of getting that discount again. Very often as well, in terms of frequency, if you do have frequent deals, one not trick, but approach to that is often to create some standardized answers, standardized pricing for given products. But that also means that you're less able to differentiate versus the competition. It means that you may not be able to exploit differences in customers and customer segments. Very often in most industries, some customers or customer segments are willing to pay more than others, maybe not for exactly the same product, but then for a differentiated product. And if your pricing or a general approach to deals is too standardized, it's not really possible to exploit those different customer segments. And obviously, the point I also mentioned with the quote from the large manufacturer is that if your competitors are faster in quoting, are faster in reacting to deal requests, you may sometimes lose business simply because the competitor had an offer in and you didn't, and well, the business goes to the competitor. Or even if you do have an offer in, but you can't react to it quickly enough to that the customer wants to change some part of the product or the associated services, again, that will be a challenge in many organizations. Now, also the issue is that if you're dealing internationally, let's say in this example here, you do have some subsidiaries around the world who are basically selling products or services, and they're dealing with local customer subsidiaries in those local countries. But then, as I mentioned, more and more procurement organizations have built international teams who, even if they don't deal directly with an international selling team, they will still coordinate behind the scenes with their local subsidiaries, and they will be able to identify and spot differences in pricing, discounts, rebates, general terms, and get the best deal at the global level. That sometimes makes it more difficult to negotiate because, as I said, the procurement organizations usually have much better insights. We know that the investment from the procurement side is about in being able to coordinate international pricing is about sevenfold of what it is for the selling organizations being able to coordinate international pricing. So there's a lot of focus in procurement of, well, I know that I'm getting different terms in China than I am in Germany, and I would like the same terms, please, now also in Germany, and therefore suddenly the manufacturer loses a lot of profitability. It also generally makes deals more difficult because one thing is responding quickly to a deal request in, let's say, France, but if you then on top also need to coordinate with your colleagues in the UK and the US and Japan just to be able to avoid any issues when you close your deal in France, obviously that adds coordination effort, it adds time, It adds costs sometimes to be sure to not do something silly or detrimental to pricing in other countries. Also, in terms of timing, I mentioned a little bit already, if it is a long-term deal, very often you cannot change the pricing or the deal afterwards, which if the salespeople don't possess the right negotiation skills, very often, because there's so much at stake, there's a tendency, obviously I'm stereotyping a bit here, but there's a tendency to not negotiate as hard as if you know that you can redo the deal next month. Similarly, especially in some organizations and some industries with fluctuating costs, the ability to forecast cost is very important, because again, if the price is locked for 12 months and you don't have any clauses about it, you are permitted to change your pricing, but your costs go up and down every 2 months. Obviously that's detrimental to overall deal profitability. And we already talked about some of the challenges of short-term deals, so the quality of thinking and decision-making, but also organizational reaction time. The other day I met a German company where in theory the key account managers were fairly fast in making a decision, but they had 3 levels of price approval in the organization. So from the key account manager decided, okay, this is the price I want to offer to the customer. It had to go through 3 levels of approval in the organization, of course theoretically to avoid any mistakes being done, but in reality it meant that again it would take several weeks typically for all 3 levels of approval to go through, and thereby again delaying the proposal time and sometimes meaning that they simply lost out on business because they were not fast enough of quoting the right price. Now, so how can you really approach deals and make optimal deals? Well, we work with a small framework that you see on the screen now, that to really look at an optimal deal. Obviously, you need to have a good deal management strategy. So how do I approach my deals? How do I determine pricing? Is it a local decision? Is it a global decision? How much freedom? How much directive do I impose on the various salespeople? But really overall, how do I go about my deal strategy? Deal tools we find, especially in high transaction industries, is extremely important. All about managing the amount of information, simulating what happens if I'm changing some things, what is my profitability of the deal as such, and generally being able to manage my deals more consistently across the organization. Deal execution, again, also how to approach, for example, local deals versus global deals. How do I handle the approval workflows? How do I generally allow my organization to make decisions on deals and prices with or without intervention from a pricing team? And yes, executing the deals. Feedback and optimization we find is very often a quick win on deals. If there's a feedback loop in place, how do I actually go in and evaluate my deals? How can I optimize future deals based on the insights I get from deals? That can be, of course, done in tools, but it's also a process and discipline in itself. And very importantly, as always in pricing, it's about the people. Pricing with the right strategy and great tools, but no buy-in from the sales force, and no buy-in from the organization simply doesn't work. That applies to deal-based pricing, it applies to pricing in general. So we'll also look at in the coming slides about how can I equip my people better to manage deal-based pricing. So the first point, strategy. Well, there are different approaches to deal-based pricing strategy. One of them could be normative pricing, so the fact that, or the concept of that a central organization either local sales director or finance director or even a global pricing manager will dictate what prices should be. Basically saying, well, we are now deciding that these are the pricing parameters you can work with. Now, in a more softer approach to that is what we call guiding pricing. So that's more about putting some frameworks in place, saying, well, you cannot go below this price, you cannot go above this ceiling price. There are certain guidelines you have to follow, but there's still, for the individual key account manager who needs to execute the deal, there's still some freedom to decide a number of things on his own. So it's more guidance. It's not telling him, well, you have to do it like this. A third type of deal pricing is more related to basically insights. The philosophy behind insight-based pricing is more about, well, you present some information to the key account manager. It could be profitability. It can be certain key performance indicators on the customer and associated pricing. The idea is if you present enough information and the right information, it's not necessarily important to put directives, basically because you still need to leave the final decision making to the key account manager who knows the customer, who knows the market better than someone in a centralized function. Now, which one of these is the right one? It always depends. It typically depends on the type of customers you have. So do you have very global customers? Do you have more local customers? Is there a lot of competition in industries? There not so much competition? Is it a high transaction business or a low transaction business? Typically the more transactions there are, the more normative you would be, basically because it eliminates mistakes. The more global you are, global pricing will probably mean that you're either moving in guiding pricing or sometimes even normative pricing if the global customers are really, really strong and exploiting price differences. But there can still be some flaws and ceilings applied to global deals as well. The other question for deal pricing strategy is around speed versus accuracy. We see at the moment the tendency that companies are moving away from 100% accuracy to more towards the need for speed. The need for speed in terms of analyzing the deal profitability internally, the need for giving the customer a quote, and in theory also being able to respond to customer changes to the deal requirements, either in terms of products, services, cost basis, etc., anything that the customer would ask for. And therefore, there's a small tendency at the moment that speed is more important, but it depends on the industry. It depends on the unique competitive situation very much. If all competitors are equally fast or equally slow in coming up with deal quotes, well, it's less important than if there's huge discrepancies between one competitor and another one. But also, do you really want to have a very uniform approach to deals? Typically, if you're selling standardized products, you probably want to have more of a uniform approach with more strict guidelines, but also more strict answers to customer questions and customer requests. Whereas if it's more of a value-oriented industry you're in, you may follow more of a segmented approach where deals can be different segment by segment. And that can happen even inside the same industry. We've seen, for example, some chemical companies would easily be able to segment the services and the pricing that's associated with those services, maybe engineering services, whereas other chemical manufacturers really sell a commodity, and therefore it's more difficult to do a differentiated deal, have a differentiated deal strategy based on which segment the customer belongs to. And of course, again, in some countries, there's also some restrictions on how much price differentiation you can achieve for selling the same product or service. So again, various constraints there. Now, if it's related to global deals, well, I mean, if customers are primarily focused on local business, you usually give a lot of autonomy to the sales force. But if the customers are more and more global, or being able to compare prices globally, being able to exploit that, well, I'm buying this standardized component from you, and I know that I can buy 20% cheaper in China than I can in the US. Well, then you probably need more global rules to make sure that when deals are analyzed, when deals are executed locally, that those rules apply and the organization can't just wander off. We very often also see that in industries with a lot of off-invoice discounts, so if there's a lot of off-invoice rebates, discounts given in an industry, that makes global comparisons from the customer more difficult, because they typically compare the invoice price or the list price that they pay, and not all procurement organizations are capable of comparing target prices after all off-invoice discounts. On the other hand, if you're in an industry or in a company where you give most of your discounts on invoice, it's typically easier for procurement organizations to compare those elements across countries, and therefore the need for global rules is probably higher in that kind of industry and that kind of company. Sometimes you also face that your local markets say, well, we have this industry standard locally, and we have to do pricing in a different way, so we really can't adapt to your global rules. That can be a tough one because, I mean, sometimes it's true. It's definitely true in industries such as pharmaceuticals, that there are some even legal constraints on what you can and cannot do on pricing. But also in other industries we see the same. One typical example, if you want to manage global deals, is to at least work with some sort of pricing corridor that basically enforces a minimum floor price and a ceiling price, and then tell the markets, well, you are free to operate in the corridor when you do your local deals for these given products, but you cannot deviate from the corridor, and that gives some freedom to adapt to local service requirements, certain pricing requirements, certain discounting requirements, certain historical factors, such as we've always done it like that, even though as pricing people we should never accept that, well, we've always done it like that, but in reality that's sometimes very difficult to explain to the customer. But the point is that managing a pricing corridor means that you can still keep your global deals within certain boundaries, and thereby avoiding too many issues that they can buy goods much cheaper in China than in the US, in my example from before, but you still leave some local flexibility in terms of how to manage those deals. When it comes to execution, one question is often, well, should we have a very centralized pricing approach or more of a local or decentralized approach? Well, the centralized pricing approach would mean that there's really one group responsible for pricing, and whether it's price list or deal parameters, they're basically disseminated to the local markets from the global team. That works especially well for industries with global products or industries with truly global customers. And I say truly global in the sense that while many customers are global in terms of organization, they may not be really global in terms of buying patterns or price comparisons, at least not yet. But in industries where the customers are global, it's becoming more and more important that there's some sort of centralized pricing approach. Similarly, though, you can also have a model where it's more central guidance, but there's local execution, so back up to my pricing corridor before, where the central team will issue certain guidelines, but it's executed locally. And that still fits in most global companies and most industries still today. I do think that if we're having this conversation 5 years from now, it's going to be more strong, that the need for global coordination, the need for global guidelines or even rules will be higher in 5 years from now than it is today. And then the last approach is more decentralized pricing approach. So business units or local teams make the pricing decisions, the deal decisions, and there's not necessarily any coordination or very little coordination between the countries. That's typically only working in industries where there's very local pricing practices, or as I mentioned before, in some industries where there's legal regulation on pricing, so you can't really do anything about how pricing is supposed to be done. Very importantly, when it comes to feedback and optimization of deals, well, it's remarkable still that when we look at companies who do deals on a very frequent basis, how few actually, in a structured, systematic way, look at win-fail statistics. Did we win the deal when we made a quote, or did we lose it? And maybe we didn't only do one quote. Maybe we did 10 quotes to the customer before he accepted it. So what was wrong with the first 9 quotes? Was it purely negotiation tactic? Was it that we did something wrong, or that we had a different price, or was it purely based on service? Did we actually have the same price in scenario 1 and scenario 10? But basically looking at, first of all, the win-fail statistics. Some companies are able to say, well, yes, we did 100,000 quotes and we were successful in 57% of them. But many companies across industries really see this as one of the first challenges when it comes to deal optimization. It's relatively easy and quick to implement. The more difficult part is then when you want to add some cause analysis to the win and fail. So why did we win? Or why did we fail? Very often there's a bit of a tendency to focus on why we failed. But even also, why did we win? And was it a good win or was it a bad win? If we won because we just dumped the price, yes, we won, but could we have charged more? And that's more the challenge. Also because in the win-fail in itself, and that's why it's an easy thing to implement. It's just a statistic, whereas you basically, it's very objective. We won the deal or we didn't win the deal. Whereas the cause analysis then requires someone, either the salesperson or a controller or someone in sales management, to go in and say, well, we didn't win the deal because we did something wrong, or because the competitor was cheaper, or because the customer canceled the project, or whatever it was. And that takes time, it takes effort, it takes analytical skills, it takes data handling capabilities, which may or may not exist in the organization. And some of the practical challenges of having a feedback loop and analyzing why we won or lost is data availability. How do we get the data? How do we manage the data? But also comparability, in the sense that, well, we won one deal and we lost another deal, but then can we compare those two? Did we do the same things with the two deals, or is it just, yeah, well, bad luck in one and really great business in another, and therefore we can't learn too much from it? There are some tricks that you can apply to compare deals, and especially either looking at customer characteristics such as the customer size, the customer's turnover with you, and finding a couple of comparable characteristics, and then using those for running your win-fail statistics. One challenge that we sometimes encounter or hear is around, well, but I mean, win-fail statistics is based on historical data, and it doesn't really predict the future. And yes, it's true that in at least in theory you can't for sure know what's going to happen in the future. But we often see that if there's no win-fail statistics at all, if there's no effort at looking at, well, why did we win the deal, why did we lose the deal, then obviously it's difficult. But with a few simple statistics, especially if it's also integrated in the general deal management tool, it is actually possible to start getting some insights and adjusting behavior, at least on the organizational level. It doesn't mean you can use such models to predict everything and success failure on every single future deal. That will be an illusion. But it does mean that you know better what kind of deals where you're more often failing, or for that matter, what kind of deals where you're almost always winning, and maybe you're pricing too low if you're winning in 99.9% of those kind of cases. So historical insights can definitely, in practice, influence deal strategy and on how you adjust your deals. Tools. One of the key things in deal tools is the capability of simulating. Very often deals, because of their complexity, you cannot just say, well, here's the price and that's it. You need to see what happens if I'm changing some of my products, what happens if I'm adding some services, what happens if certain cost assumptions change, what happens to profitability. Can I bundle some of my products and get the customer to accept a different price? What happens if I'm increasing my price but accepting a bit lower quantity from the customer? What happens if I'm changing my supply chain setup, etc., etc.? And most of the time, what we see is that a powerful deal management tool will include simulation capabilities. That, and then the ability to see the full profitability, as indicated also here. This is a classical price waterfall. But it's remarkable still how many deals that are done without the salesperson having the necessary insights into the deal's profitability. It doesn't mean that you should only do cost plus pricing, but without any idea about whether the deal is profitable, marginally profitable, or completely unprofitable, it's really, really difficult to expect the salespeople to make the right decisions. A good tool can again help there. That also brings me to the next point about whether to share information or not share information with your team. I mean, remarkably enough, we see a lot of organizations where production costs are very closely held, and maybe for good reasons. Production costs may have a competitive impact, but if you can't use production cost as a salesperson to understand what is my profitability, you cannot guide the salespeople to go to the profitable deal or not. One trick or one approach we've seen is that instead of using direct profit numbers to guide the team, we've seen some organizations where they would basically make a profit interpretation in a profit class. So they would say, well, we have 10 profit classes. 1 is the least profitable and 10 is the most profitable. And then we will not show to the salesperson what is the exact production cost, because that's a secret. It's a competitive secret. But we will tell the salesperson that if you change these parameters of the deal, then we will score the deal as profit class 5, or profit class 7 if you change some other parameters of the deal, or profit class 8 if you do, again, some other changes to the deal. So it's more about scoring the deal and giving a feedback to the person. But again, I think also that in many organizations there has been a trend over the last 10 years that they are sharing more information simply to make the key account managers more equipped to make a proper deal with the right insights. One side note, or one additional aspect, is if you manage global deals, and that can sometimes sit in different ERP systems. Maybe they have a different ERP system in South America than they have in Asia, and in Europe they have a third system because they bought a new company in Europe. So how do you combine deals? How do you analyze deals from a tool perspective, but even also just practically? If you're doing a global deal with a customer who is buying in South America, Asia, and Europe. Well, one of the things, again, in a good deal tool is that you have at least the capability of combining deals. So you can either analyze the total deal, the sum of the local deals. Maybe you can issue some guidelines, some rules about pricing in the deals from a global perspective. But it's more and more necessary to be able to combine deals in a deal tool. One example from Stratinis Pricing Suite about deal management. This is an example from a relatively simple deal where basically the user can look at some products. So he or she will have multiple products to manipulate. In this case, he's selling some quantities. He can change the quantities. He can also change the price. And then he sees a deal profitability at the bottom, both in absolute terms and in percentages. And he also has a profit target. He can add some more products to the deal. He can remove products from the deal. He can import existing pricing or edit all the cost assumptions or other assumptions behind the deal. And every time he changes something, it automatically then updates in the customer profit number. He also has a profit or pricing target. So basically from Price Optimizer in his pricing suite, or for that matter from an external model, there's also a suggested price. So well, if you go and see this customer and you sell these products, then these are the prices you should try to achieve. But similarly, there may be a minimum price that is not acceptable to go below. So then our deal manager will basically include that as a floor price and say, but this is the minimum price you can charge for that product to this customer, and you can basically not go below that. Again, that can come from our rules manager engine, or also from external data, depending on the organization and the needs. When it comes to people, and I really say pricing in general, but also deal-based pricing, it's very important to have the people on board. That, of course, starts with do they know how to use the tools they have, and that's regardless really if it's an enterprise tool such as Stratinis pricing suite, or for that matter if they're simply using some really, really complex Excel files or something in between. Do they know the tools? Do they know how to operate the tools? Do they know how to get the most value out of those tools? But as important, and that's one of the key challenges we often see, is do they respect the tools? And respect in the sense that do they accept that if the tool says, well, here's a target price of 20 that you need to charge the customer, does 20 sound reasonable to them? And if it sounds completely unreasonable, it's just because the computer says so, but I really don't believe it. So I'm trying to somehow trick the computer to give 18. I'll just put in 18 and I don't care what the computer says. It sounds like, yeah, but it can't happen. It happens a lot. And it happens with existing pricing. It happens in particular also with price increases, that maybe the tool comes up with some suggested deal prices that, well, these are the deal parameters you should work within, and now there's a price increase, by the way. But if they don't respect the tools, if they don't understand the tools, it doesn't matter. We recently worked with a large European company where they built a very elaborate and, at least in a theoretical sense, a very good model for making the target prices, the suggested prices per deal. But actually, the salespeople initially didn't understand the model. They didn't really understand the input parameters. They didn't understand how the target pricing model came to that number, and therefore they said, well, I can't use it. But with some change management efforts, this manufacturer has actually managed now to get a much better acceptance of the prices. It's still the same prices, still the same model, but because they respect it, they're also willing to translate it into to action with the customer. Another very important question these days is, can salespeople sell value? Can people in the organization sell value? One thing is to say, well, my costs are 10, so therefore I need to have at least 11, but that's not really a winning formula in most industries anymore. It's more about, can you argue for why your product is a premium product? Can you argue for why the price of 12 is actually a good and fair price that adds a lot of value to the customer's business, and therefore 12 is a fair price? If the whole discussion is only about the cost, typically the customers will win. If the discussion is more about value and what drives value for the customer, especially in B2B, then it's a different ballgame. And that often means that salespeople need to have a different mindset through training, sometimes through recruitment as well. Some people are more capable than others, but basically it's about, can the salespeople sell value. Another thing we've seen with deal-based pricing and especially in high transaction companies is what about the key performance indicators? And do they become an excuse sometimes? Well, the floor price says that I can go down to 2. Yes, there's a target price of 3, but as long as I'm above 2, I'm okay. So I'll sell a 2.01. I don't really care about 3 because, well, floor is floor, right? So I can go as low as floor, and it becomes a self-fulfilling prophecy or an excuse for actually pricing. that can be quite important, and usually the trick there is to look at reward structures. And if you have two KPIs, let's say in my previous example, target and floor, to at least reward success against those two KPIs equally, or maybe even reward more towards the target price adherence, so that it doesn't become an excuse that, oh well, but I can go down to floor price, and that's very often a challenge. The other challenge is that, I mean, most people are quite busy in their day-to-day jobs. So if you are a local sales manager in Germany, how do you make sure you also coordinate between yourself and your colleague in Brazil who's selling to another subsidiary of the same customer? That can either be through the tools. So very often global coordination or international coordination is a question of tools to support that coordination, but also other approaches such as instigating, for example, a key account forum where every month, every 3 months, you actually enforce that these people dealing with global customers, that they meet and exchange views and exchange ideas in such a way that they can make sure that they're not doing anything stupid, or that they're more coordinated. And one more thing when it comes to deal-based pricing is that we often see that training, not in whatever form, but in many forms, can actually give a high payback on the salespeople's capabilities in deal-based pricing. Classical negotiation skills are definitely very important. Tools usage, so how to use tools. If you have some sophisticated tools for simulating different deal scenarios, use them. And yes, it may be a bit more complex than just giving the customer a price, but the return is quite often very high. And not last, but definitely not least, value selling and the ability to argue for why my price is right, and not just, oh well, yeah, but the cost, our costs have gone up a bit, but really arguing well for value and being proud of the price, selling the price itself. Is very important, and there's some brilliant people who specialize in this kind of training that will also be happy to put you in contact with if you would be interested in that kind of training for your sales force. We see a very high payback on that kind of training, and a very high a very high improvement in deal quality. Typically, if it comes to people, typically organizations will go through some building blocks or some development phases. Information sharing, give them more information, give them a toolbox, some tools, make sure that you do regular training. Changing reward structures is definitely the way forward, but also takes some time, because sometimes salespeople are really reliant on bonuses, and if the way they get those bonuses is changing drastically, there may be acceptance, but very often there's also a lot of resistance. People don't like change. So changing reward structures definitely should take place, but also the higher level here indicates that it's more difficult. And then generally also adjustment to governance. So how do you manage prices? What can salespeople do? What can't they do? Again, it's probably very important, especially also with the deal feedback and the deal the win-fail statistics. But again, it's also something that people may resist more. The first parts are more easy to do and quicker to do with less resistance. So in summary, some of the key areas to focus on when improving deal pricing. Decide on the strategy. So is it normative pricing, or is it more guiding pricing? Do we want to be very, very fast when it comes to quoting and getting deals done? Or do we want accuracy? With tools, you can move that a bit, so you can be faster without losing accuracy. But sometimes it's a bit of a trade-off, even with some brilliant tools for doing deals. Agree on some internal KPIs, and agree on a language. So when you're talking profitability, when you're talking pricing, do everybody know what they're talking about? Do people accept that this is how we evaluate deals, so that we can manage it properly? And then get some tools to support the deal making. Very important. It helps simulating. It helps controlling all the vast amounts of data that many companies operate with these days. And last but definitely not least, people. Make sure that you have the people on board, equip them with not only the tools but also with the right training and negotiation in value selling and general tool usage. Especially if you invested in a tool and a training program, they should definitely be able to use it properly. And with that, we end the main webinar. There has been a couple of questions during the webinar. The first question is, can you please elaborate more on how the course analysis works when you talk about win-fail statistics? Well, as I said, the win-fail statistic in itself is relatively quick and relatively easy to introduce. It's also quite fact-based, and yes, we got the deal, or we didn't get the deal. But when it comes to course analysis, so why did we lose, or it's sometimes more difficult. If you have a deal tool, if you have a quote tool, very often these tools will have built in some sort of field where basically the salesperson who is responsible can either choose a free text field and write some explanation, or for that matter choose from some categories. Here it's actually good advice to, in your course analysis, to make a couple of categories that they can choose from, so that you can run some statistics on it quite easily from the tool, or even just from Excel afterwards. But that's on the fail side of things. I think it's also important to emphasize that a really good course analysis will also include win statistics. So why did we win the deal? Or what did we do right? Are we always winning the deal with this kind of customer, or in this channel, or in this country? And if we're always winning the deal, even if there are other competitors, maybe we, as mentioned before, maybe we are pricing too low, or it's an indication that maybe we can change some things and get more profit out of it. Again, depending on the deal frequency, if deals happen very often and deals are renegotiated very often, you can change some parameters and actually see it in your deal statistics, in your win-fail statistics. If, on the other hand, deals only renegotiate once every 3 years, obviously it takes still some consideration when you move from running the statistic to actually changing some of your deal parameters, because you don't see the impact very fast. And if you made the wrong decision, it's more difficult to handle. Another question: is it really the full profitability that you showed in the deal manager? Our data comes from various sources, and we have great difficulty in gathering it. Yeah, it's a very common challenge, and there's no right or wrong answer. I personally believe that if you have a lot of deals with a high deal frequency, if you have a couple of data sources and you're able to combine those 2 data sources, 3 data sources, it's probably better than trying to combine 7 or 8 different data sources to get an absolutely accurate number. That said, though, especially in deal tools, there's very often differences. In Stratinis Pricing Suite, we don't, for example, only take data from ERP, from SAP or Oracle, but we usually combine it with business intelligence cubes, or with Excel files with data, and we can still combine that data from multiple sources. But I would warn against trying to have perfect data and perfect data quality before you embark on certain pricing initiatives. It's in most organizations it's impossible, or at least very difficult, to achieve full pricing and profitability transparency. And having a 90% correct number, but having it immediately, is probably better than trying to get a 100% accurate number, a 99.9% accurate number, but it takes you 4 weeks to get that number. Especially if the customer is not willing to wait for more than a couple of days before he wants the price. So speed, as I said, is more and more prevalent in many industries, and this is probably a case of that 90% correctness is better than 100% if it takes too long to get to 100%. Another question, probably the last one timing-wise. In your experience, what's the best approach to break down the resistance against deal management tools and build general confidence so the sales team considers it as their friend and not their enemy? Well, another good question, and it's not only limited to pricing tools and the pricing discipline. Actually, you'll probably see the same if you're implementing ERP solutions or CRM tools to a sales force. There can be resistance in many functions and in many industries, in many types of organizations. Probably, especially deal tools. If there's simulation capabilities, we see there's a higher acceptance than if it's just a so-called deal tool that basically spits out a price and tells the user, well, this is it, go away. Just give it to the customer, and the salesperson becomes a messenger. Whereas if it's a tool where the salesperson can actually simulate what happens if I'm changing some of my deal parameters, what happens if I'm adding products, subtracting products, what happens if I'm offering the customer some additional services, what happens if I can change my supply chain in delivering the customer, etc., and simulate things. The salespeople generally find that that's valuable because that helps them in their day-to-day work. They may accept that there's some additional learning, there's some additional needs to be fulfilled to use a tool like that. But they very often appreciate that if it helps as much as it requires additional work, then they will use the tool more easily. Unfortunately, time is now up, but as I said in the beginning, we will send the presentation to everybody who attended the webinar today. And if you have any questions, you are more than welcome to contact us either through my direct contact here or simply sending an email to sales@stratinis.com, and we'll be happy to give you our feedback and advice on various challenges that we have seen in some of the major companies that we work with. And with that, today's webinar ends. Thank you very much for your time. Bye.